Today, Fed to markets, no easy victory. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and pro news with a distinctively Australian flavour. Wall Street's main indices closed lower on Wednesday after weak economic data and hawkish comments from Federal Reserve officials sparked worries that the central bank will keep tightening policy, perhaps enough to cause a recession. The S&P 500 fell 1.6%, that's the worst decline in a month, while the tech-heavy Nasdaq 100 snapped a 7-day rally after reversing gains of more than 1% earlier. And stocks rallied before that as Treasury yields fell across the curve on bets weak data would prompt the Federal Reserve to downshift its tightening policy. Before the market opened, US economic data showed retail sales and producer prices declined more than expected in December, and also production at US factories fell more than expected in December, and output in the prior month was weaker than previously thought. But St. Louis Fed President James Bullard and Cleveland Fed President Loretta Mester stressed on the need to raise rates beyond 5% to bring inflation to heel. Growth in US prices is expected to ease in the year ahead, contacts surveyed for the Federal Reserve's latest Beige Book, which is based on anecdotal information collected by the Fed's 12 regional banks through to January the 9th and compiled by the Cleveland Fed. Selling prices increased at a modest or moderate pace in most districts, though many said that the pace of increase had slowed from that of recent reporting periods, the Fed said in their report, which of course is published just 2 weeks before the next meeting of the policy-setting Federal Open Market Committee. On balance, contacts across districts said they expect future price growth to moderate further in the year ahead. And the Fed commentary also highlighted the disparity between the US Central Bank's estimate of its terminal rate and market expectations, which were at a rate peaking of 4.88% by June. Traders are now betting on the 25 basis point rate hike in February, with the Fed watch rate probability for the next meeting currently sitting at 95.3% for a 25 basis point hike. On balance, contacts generally expect little growth in the months ahead, according to the Beige Book, which noted that overall activity was relatively unchanged since the prior report. And in fact, the New York district reported a decline in economic activity, with the drop being especially sharp in manufacturing. Fed officials have remained unified, though, in their calls for additional rate hikes to fight inflation, even as recent data has shown some progress. You just can't declare victory too soon, Fed Richmond President Thomas Barkin said on Tuesday, and Fed St. Louis President James Bullard said on Wednesday that the central bank will want to keep rates higher for longer as insurance against a lingering inflation similar to the 1970s. It seems that investors are finally coming to the conclusion that getting inflation under control is not a free lunch, and that all the tightening the Fed has had to do to get inflation moving in the right direction comes with economic costs, said Michael Reynolds, Vice President of Investment Strategy at Glenmead. Investors may have had this false belief that this soft landing scenario was a higher probability event than it actually is. While risks have had a positive start to 2023, with investors encouraged by signs of fading inflation and a swift reopening in China, it remains possible that the rally is a head fake and that economic data will ultimately disappoint, said Mark Hayfell, Chief Investment Officer at UBS Global Wealth Management. The lagged effect of higher rates could represent a greater drag on growth than expected. So in the end, the S&P 500 lost 1.56% to end at 3,928, while the Nasdaq Composite lost 1.24% to 10,966, and the Dow Jones Industrial Average fell 1.81% to 33,296. With Wall Street's major averages showing gains so far in 2023, Sam Stovall, Chief Investment Strategist at CFRA Research, said some investors saw the weak data as an opportunity to take profits. The market was overbought. Today's economic data served as a trigger to initiate a profit-taking spell, and the groups with most profits to take have been the ones that have done best over the last year, said Stavel. Investors are also focused on the fourth quarter earnings season as a window on how corporate America is doing against the backdrop of higher interest rates. Analysts now expect year-over-year earnings estimates from the S&P 500 to decline 2.6% for the quarter, compared with a 1.6% decline at the beginning of the year. Microsoft and Amazon, two of the world's biggest companies, began cutting a total of 28,000 jobs on Wednesday in a post-pandemic reckoning that has left almost no tech name unscathed. The software giant began notifying some of the 10,000 workers who will lose their jobs this quarter and made a $1.2 billion charge as it braces for slower revenue growth. Microsoft shares fell 1.89%, while its Seattle-based neighbor and cloud rival Amazon started sending out emails to people in the US, Canada, and Costa Rica who are among the 18,000 people whose positions will be eliminated. Amazon was down 0.61%. IBM shares were in the red after Morgan Stanley downgraded the company's shares to equal weight from overweight, but Moderna shares rose after reporting data that demonstrated the effectiveness of its respiratory RSV vaccine. PNC Financial Services Group tumbled after the company missed estimates for the fourth quarter profits, and Charles Schwab stocks fell 2.5% after it fell short of expectations for fourth quarter earnings, a theme that I think we're going to see as the reporting season continues. The dollar index hovered around 102.4, while yields on US bonds dropped, with the 10-year down 4.57% to 3.373, while the 2-year was down 2.56% to 4.0846. Elsewhere, the yen dropped as much as 2.6% against the dollar after the Bank of Japan doubled down on defending their stimulus, defying intense market speculation. But the currency later traded down to 128.84, while the Japanese 10-year bond rose 1.43%. UK inflation was reported a little lower at 10.5% thanks to falls in energy and petrol, but offset by rises in food, housing and wages. Eating out has become significantly more expensive, and further energy price rises are expected later. So while the base effect where old numbers drop out of the annual calculation in the next few months, inflation is likely to stay well above the bank's 2% target, suggesting higher interest rates for longer. That said, the Aussie pound cross rate slipped back to 0.5622, having been above 57 cents recently. And finally, Bitcoin came back 2.34% as it continues to ape US equity markets, but remains above the 17,000 level that it's stuck at since November. Gold futures eased a little to 1,906, and both Brent and WTI oil were pulled lower by fears of less demand for oil in a slowing economy. WTI was last at 79.44, and Brent stood at 84.63. So the point to make here, of course, is that the level of uncertainty across multiple markets remains very high, and therefore anybody who's banking on significant market surges are probably not reading the ruins very well. The truth is, this next few months will be pretty chaotic, and at best I think markets will go sideways. It's unlikely that we're going to see a significant recovery, at least until interest rates are at their peak, and then the first cuts follow. The key question, of course, is when will that be? The market is saying in the US, middle of the year. The Fed is saying 2024 at best. I guess you pay your money and you take your choice. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.